Module 11, the market update, along with recent trends and what's been happening in terms of macroeconomics, commercial real estate, and what we're seeing in the market. And just to give a little bit of background, what's been happening pre 2024, you had the COVID pandemic, the country shut down for a few months at least. I think we all forget from time to time the amount of impact that was and how much of it was seen as a huge threat to the economy, which the government started to print money at a rate much higher than what we saw in the 2008 global financial crisis to get things going again. And this created a lot of inflation that we found right around 2022. We started to really see that. The Fed reacted to increase interest rates, which brought down the prices of commercial real estate 20 to 30% off the peaks of 2022 and 2023. Here you can see the index to it in comparison to the Great Recession. Like I said, down maybe 35% from the peak in comparison to 29, maybe as impactful in commercial real estate or more. So certainly if you're a newer investor entering the market at this time in commercial real estate, it's a great time to get involved. And I will point out that this is very different than what you're seeing in residential real estate. Very different dynamic. The reason being in commercial real estate, you're seeing this impact is because the loans are on a lot shorter renewal cycles, as opposed to 30-year mortgages or what you'll see out there people getting. In commercial real estate, you typically have anywhere from 1-year debt to 5 to 10-year debt. So a lot shorter cycles, which culminates into this correction here and why you didn't see it in residential real estate. And as investors, we want to be contrarian investors, investing in things that have been beat up. What are things that are cheap and on discount, as opposed to fighting the urge to go to what's been working and what's been hot? I think all of us understand the concept of running over to the Las Vegas craps table. That is the one with all the people screaming and yelling, and eventually the 7 rolls out. No different than any of these asset classes, such as commercial real estate, residential real estate, stocks, tech stocks. All these asset classes are on different market cycles. And at least for where I'm coming from, I don't have a crystal ball. I don't think anybody does. If you think you do, maybe you should be investing in the stock market and doing a bunch of day trading. What we're trying to do is look for where there is value and figure out where the discounts are. And certainly the discounts at this point in 2025, you're seeing this in commercial real estate. Just one data point from our portfolio, we had a BPO, which is not quite as good as an appraisal on this asset in Alabama, where it got appraised for $22 million earlier in the year. But in late 2024, it was appraised for $26 million. Certainly, we were value adding the asset, but that's quite a bit of differential there, where to me, it suggests a reversal of the market. Now, we don't know this for probably another couple of years from now. And at that point, it'll be way too late to jump in. But from what I'm seeing, we're starting to see that reversal of the market. And that was just one data point. In the last market update, which I put out quarterly, how the cap rates in the market impact directly what the asset values are worth. In this example, you have an asset creating $1 million in net operating income every single month. Obviously, you're trying to improve that over time by renovating units or improving the management practices and the efficiencies, cutting expenses. Again, same property, running at the same efficiency, $1 million in net operating income minus expenses before debt service. And at a 4 cap, where if you go through the syndication e-course, we talk pretty heavily about this topic so you can understand it fully. But at a 4 cap, this asset would be worth $25 million. What we saw is a reversal of the cap rates to about 1.5% increase. That sounds good, but it's actually not. That means that when the cap rates increase in the marketplace, the prevailing market, what these assets essentially sell for, or if you're a business owner, what is the multiplier or what the assets are trading for? You see this $25 million asset now trade for a 5.5 cap, which is $18 million, causing this 30% drop in the market today. Again, same asset, same NOI, but because the market is depressed, it's selling for less. So if you're seeing the value in this, you're buying these properties for much, much cheaper. Of course, we can't really say that the market's going to go back up, but because it's dropped at a certain point, or the cap rates have rebalanced to the 5.5 range on that originally 4% asset, you would expect to see some good movement in the future. Maybe not the near future, but certainly in the long-term future. So this is broken down in terms of Class A, B, and C assets. We talk about this in the syndication e-course. Then what you've seen is the new supply coming on market. We're going to be talking about that dynamic happening here in a little bit. But the biggest impact that you're seeing right now is their biggest decrease in the Class C assets. At one time, they were trading in the high fours, but we saw the biggest drop in those asset prices, some of them even going to the 7% range. So if you had a $21 million asset, it's now trading in the $14 million range. Class A and the Class B stuff didn't see that high of a correction there. And this is a sort of interesting dynamic happening now. It will probably play out for maybe another year, which is why we're targeting the A and B assets this time. But it very well may reverse depending on when you're watching this video. And so the reasoning behind this, up until 2020, there was essentially free money in the marketplace, or what we call the capital markets, or the loans out there. If you want to fixate on one thing, the Fed rate, right? The Fed had interest rates pretty much at zero. And it was a time of, some people call it free money, essentially. So a lot of great loans, which powered a lot of acquisitions in the real estate market in general, residential and commercial. So you started to also see developers get involved in this area. And we were actually part of this wave ourselves. We started to develop in 2020, and we got a good amount of this good, cheaper money before the interest rates started to jump up in middle of 2022 and got to really difficult levels by the end of 2022 going into 2023, and held there for quite some time. We started to see some recent cuts in rates, but still interest rates are still high at this point. But what I wanted to focus your attention on here is this is the graph of the US housing starts. So all the new assets that are going through development right now. Now there is a bit of a lag. This is supposed to account for starts, things that are starting. But you have to understand that it takes about a year or two for these assets to be born. Sort of like house babies, right? Babies take 9 months to be born after inception. Here it takes about a year or two. So what you see here is this little spike in 2020 to 2022. And this is at the tail end of the free money. At that point, the starts started to drop off quite drastically here. You're going to see it even drop off the map in 2025 and 2026, meaning that 1 to 2 years later, you're going to see that new supply hitting the market. But right now, this new supply is really hitting the market harder in some places. And of course, you have to dig more into the submarkets. We've got some developments in Huntsville. The new developments actually are particular developments too, or is in the west side and the Madison side and the northeast, where some of our assets in the central part of Huntsville are really impacted by this. So again, a lot of what I'm talking about here is just generalities in terms of the nation. So here's CBRE's estimates on where this is all heading, and kind of an extension of the last graph. Now this is more deliveries. Last one was more starts. This is more deliveries. So it takes into account and estimates that 1 to 2 year gap when those starts will actually unfold in the market and open up and be able to take in tenants. So as I mentioned, you're seeing the tail end of the peak hit us in 2024 and now again in 2025. But again, drop off a cliff because a year or two prior, people stopped building. because the interest rates were high, and it just was not a conducive environment to go into construction projects at that time. And we ourselves, we held back some of our projects from even going to construction because, to give you a view from the ground level, at that point, you were looking at 10, 12, 13% interest rates for a construction note, where previously we would have been in at the high single digits. So this new supply is hitting the market as of 2024 and as of current. And the question is, depending on which market, you're starting to see the light at the end of the tunnel. So what I'll direct your attention to here is the little triangle, which is supposed to be the peak of the delivery. So based on these markets, and again, every market is a little bit different, and each of these markets has maybe a dozen or two different sub-markets to dig into. But just breaking these down one by one, like a market like Austin here, they're saying in Q3 of 2024, which is in the past, that was the peak of the new deliveries. And then you're going to start to see declining vacancy and negative rent growth at that time. But things quickly pick up from there as you sort of have this transitioning period. Once you get into the yellow period, I think that's the time where the lower end assets, the Class C assets, are rebalancing out. As we mentioned earlier, that the Class C assets had a bigger hit than the higher end Class A. And the dynamics there, when the new assets hit the market, they typically give a month or two of free concessions. The tenants, they're not the smartest people with money, and they can be duped into these teaser rates, and they don't take into account the fact that concession or that free month's rent is going to burn off the next year. Just them buying the latest big truck that comes out, the latest model, they're at all by these really nice places to live. And just like most people out there, especially people who don't have money, they overextend themselves and they obviously rebalance. So that also is the second reason for that whole differential in the Class C assets. Right now, for newer deals, we more look at the higher end, the Class A and B, but we do have these Class C assets that are seeing this dynamic play out right now. The takeaways from this slide right here is that the light at the end of the tunnel, and you're going to start to see that rebalance come back into the lower end assets. So every market is on a different cycle here, but again, these are the general national trends developing. Certainly markets like Atlanta, Phoenix were some of the more harder hit markets out there. The next slide is going to extend the conversation more into when we start to hit that reversal in terms of occupancy and rent. When we transition from the red to the yellow, right now, this is a snapshot at the end of 2024. There was a survey of single family home investors, which sort of mimics the space here in different regions. Basically, are you guys looking to increase rents or decrease rents in 2025? And if you're obviously seeing here a pretty bullish majority looking to increase rents somewhat moderately between that 1% to 3% threshold on average. And bringing you back to that first couple of slides, you saw the cap rates jump up, which is bad for market values. Good if you're a new investor, right? Because you're entering the market good basis. And this is what we saw. We now know that 2022 was the bottom of the market based on this graph here in terms of cap rates. And right now we're seeing it at the recent peaks. And this is when a lot of more old time investors, they're very simplistic. They say buy when the cap rates are high or property values are low, and try not to buy when things are on the decline or certainly on these levels. So if you're a new investor, this is the buy signal. Unfortunately, for some investors who just didn't have market timing on their side, they happened to pick up assets, and probably the worst time in really the last 12 years. This graph doesn't extend out, but pretty much we had a nice, slowly declining cap rate market or improving market values since 2010. I follow a great independent news source called ITR Economics. I try not to focus on what's on YouTube or the daily news. Even Fox News, CNN, and Wall Street Journal, they always seem to be about a year or two behind, trying to always follow the more viral trends, which I don't think currently depicts on what investors should be looking at, certainly people within the industry. So ITR Economics, they have a very high level trends diagram here where the old one from October 20 is on the top. The most recent one at the start of 2025 is here on the bottom. And you've seen how these sectors have played out on the cyclical timeline. And again, this is what's called the market cycle, right? Things go up and down. And what you saw was housing and the financial sector hit rock bottom with their interest rates. So next time that interest rates skyrocket, maybe that's 6 years later, maybe that's 12 years later, we now know that the housing and financial sector are very impacted by interest rates, and those will be the first to go. And then you've the rest of the market to follow. I think there's a big misperception out there. People think that when the interest rates start to come down, it's the indicator that you're going to start to see a correction in the stock market, which would be about now. It's misconstruing causation with correlation. Normally, the Fed will lower the Fed rates when things are at its worst. The market just can't stand the punishment of the high interest rates, and they release the brakes, release the pressure just in the nick of time. And then there's some type of correction in the stock market or what you're seeing in these other sectors up here. And we don't know yet if the Fed has engineered a soft landing. I actually think that they did a good job at this, right? They were looking at pretty ridiculous levels of inflation. With them only having one lever, which is the Fed rate, the interest rate, they do what they can do. Some people argue with me and they say the Fed is evil and somewhat manipulated by politics, but it is what it is, right? I just try and look where the puck is going and try and stay unpolitical and just look at big movements. And this is how it's played out this last interest rate hike cycle. So again, what we'll probably see is some type of correction in the rest of the markets out here. But what we've already seen is the financial, wholesale trade, and production come through the bottom and move to the top per IOTR economics. And the housing sector has yet to really recover at this point. Now the housing, and we've been watching this over the last couple of years. In 2022, we stopped buying when the interest rates started to go up. And we were pretty inactive in terms of multifamily value add and development plays because the interest rates were just too high. Essentially, what we were looking at is that at that point in that year and a half, and I guess it was a year and a half, 2 years. Sometimes I forget because time just flies. The prices were still high, and it took a long time for the prices to correct that 20, 30%. Now it's all in hindsight. It's in the graphs. It's in history. But when you're living it, things just take a lot longer. Specifically, still think that their apartment is still worth this. The new buyers just aren't buying because they can't get loans to justify that price. Since then, you've seen this sort of equilibrium happen where prices come down drastically and culminating where the interest rates are. And now the interest rates are starting to come back down too. Now you're starting to see this test of the market of when you come up in terms of the general cap rates. The news headlines here, these are just segments, especially if you're newer. When this all happened in 2022, the segment out there was survive to 2025. It was going to be a rocky go. Obviously, commercial real estate prices came down quite drastically. It was always predicted that 2025 was going to be the start of this positive sentiment shift, which we've been starting to see. CBRE still likes the multifamily sector because of its high, strong rental demand, improving occupancy, and excelling rent growth as we start to see the new supply get absorbed. And then, of course, that new supply hitting the market, new builds are going to drop off the cliff after this year, which will also increase that dynamic there. We're starting to see sale activity go back to pre-COVID levels. I think in some accounts you saw activity drop off a cliff to maybe about a third or 20% of the transaction volume this last couple of years. If you're a buyer, and we were buyers, this was our viewpoint, the prices of these properties are still pretty much where they were, but my debt service is way, way higher. I can't pay that price. And again, this is why people just were not transacting at that time. So 2025 is likely to see a lot more transactions. We're going to play things, I think, a little bit more differently than some people. I have a separate video, which we'll also put here on the side for you guys to look at, taking a look at two different types of multifamily value add play, because the devil's in the details. And unless you go through the full syndication e-course, this is why I urge you to, if you're looking at these deals, ask questions, right? That's how you understand the nuances in these individual deals. There's a big difference between a sort of longer 5-6 year, longer time horizon, multifamily value add play with agency, fixed debt financing, and more of a turn and burn multifamily value add play where you're in and out in 2 to 3 years. Huge difference. And that's why I tell people, don't lump all this stuff into multifamily value add, because there's different types of business plans out there within that world. And based on an investor and your next investment, you need to tease out which is the right one for you, or what are you missing in your portfolio in your quest for diversification across the spectrum. Other things, short-term challenges won't vanish, but the opportunities are really starting to emerge. And if you're thinking of this as a reset of the new market cycle, some people think that now's the time to just get in, right? In a way, it's like 2010 to 2012. That said, to me, maybe I'm becoming more mature these days. I always just say, take the dollar cost average approach. Just always be building. Of course, now is a great time to get started, especially after this correction, but take the approach of you're just going to be diversifying over a longer time horizon, 4 to 7 years, and constantly just deploying in projects. Maybe that's one deal a year for you. Maybe that's 4 or 5 deals spaced out every single quarter that you go into, that you do this for 4 or 5 years and get into a dozen or a few dozen deals plus. The ideal working model is that you're in dozens and dozens of these types of deals, and you're in a diversified portfolio of different asset classes. That's why we're getting more into the PE space. I think the lesson learned this time was the time horizon, right? Buying in any type of real estate or even any types of investment out there was going to be very difficult. And in some cases, a losing case if you're buying at the peak of the market and there was a drastic correction in your industry. The lessons learned, and this kind of where I think as a group, we've done, I think, at least 60, 70 plus projects. I think we're one of the bigger organizations out there with well over 900 investors that have invested with us in the past. We're not one of these newer outfits that have done their still first dozen or a couple dozen deals. In that, we've learned a lot of things, whether they're working with the right or wrong people or these different market dynamics. So the first thing here is floating debt. I don't think it's mostly the floating debt is the issue, but I would also focus on number 2 here, which is the long terms that we're looking to get now. You can get these types of loans that are more known as bridge notes, where they are 1 to 3 years, which are great in terms of costs and agility to get in and out of a note without a huge prepayment penalty, which augments your returns there because you don't have to pay that on the exit. But when there's a big market correction, you're exposed. Now, right now, our theory is prices are pretty amazing, right? Like you're picking up some of these properties where your debt service coverage ratio are well over 2. This is unheard of. Normally deals pencil at 1.25 debt service coverage ratio. So right now you can go in with long-term agency financing, which is higher cost, and you'll be all right. But these are some of the lessons learned that I would say put in your back pocket as things to really keep in mind when things are frothy again. Maybe that's in 29 or 2032 for all we know, right? Again, we don't know when the market corrections will happen. So some of the other things, insurance and taxes, now these are uncontrollable expenses. And this is a reason why our movement more towards private equity too. In private equity, a lot more levers to improve the financials of a property. And you need these uncontrollable expenses such as insurance and taxes, which how do you deal with insurance and taxes? You pay it. We try to fight it in court as much as you can. But essentially, these are, again, part of on your P&L is uncontrollable expenses. And what we've seen over the last several years, insurance triple, quadruple in some of these places. And then taxes, especially when you're investing in emerging markets, can more than double on you. And between these just two line items on the P&L can be maybe a third increase of your total expenses, or even a half. This is in the Wall Street Journal. It came out December of 2024. Pretty astonishing. This is more for residential owners, but tells a story on the commercial real estate side too. But taxes and insurance now cost more than mortgages for many homeowners. This is crazy, right? This is the total thing where grandma and grandpa and the baby boomer never had to deal with this stuff. But this is the sort of the reality that we live in today. I think another lesson learned that we've seen is caution when investing with other less sophisticated investors, certainly non-accredited investors, because when times get tough, and times will always get tough, right? You can't expect always to go into ventures and it'll be smooth sailing. As Mike Tyson says, everybody's got a plan until they get punched in the face. What we're trying to do is invest alongside larger partners, family offices, right? People who are more financially able to weather these types of storms out there. And when times are tough and capital calls are needed, sometimes it's good to be in a pot of investors where you're a small fish. But this is a lot of the stuff that when we started our organization, we just did not have access to these types of deals and people. It's a lot of it's just people climbing the ladder. My first, I would say 15 deals, a few of them just were with the wrong people. And that was just like any new investor out there. You get into circles, and especially some of these groups that teach people how to be a general partner from scratch. They try and sell the dream. They try and get these guys to, with no real estate experience, no entrepreneur experience, to buy 200-unit apartment complex. And again, that's specifically why we trying to swim upstream ourselves to do multifamily development, because it's a lot more higher qualification to get those types of loans, and why we're also getting now involved in private equity. Not to say that we'll never do a 1980 multifamily Class B value add renovation project. It's just a very competitive space with a lot of new players always emerging in that space, where it makes getting the deals very highly competitive and ultimately pushes the price. I think if we are going to go down that direction, we are at number 5 here. We're going to focus on smaller acquisition sizes to be a little bit more nimble, to get in and out a little bit quicker. These larger properties, these 300 units, 400 units, they take a lot of time. If you think of it, steering the ship around. And this kind of coincides with, as I mentioned earlier, focusing on the more nicer properties, the Class A and B, because just better tenant profiles, better locations. I think at the end of the day, location, location, location. And that also dictates your tenant class too. We started a lot with these little crappy Class C properties. We had one in Fort Worth, Texas, where we more than doubled our money on earlier, but the collections never got above 80%. So you always had 2 out of 10 deadbeats that just skip rent consistently. Another thing to look at, and this is controlled within, the banks don't give us high loan to values these days. And this is impacted directly by the interest rates, which I'll get there here in a little bit. But you're not going to see that come back into the levels that you did see in pre-2022. But I think the one thing we are going to focus on, again, as we always have, is more workforce housing, non-luxury types of developments and projects. And this is just following the long-term demographics. I got another slide on this here in a little bit. And as I mentioned before, just from personally speaking, to just try and build my portfolio over 4 to 7 years, because you cannot time the market. You don't know. Nobody's got a crystal ball here. So the best thing to do is to just dollar cost average. And sure, something's going to happen at some point, hopefully only to that one portion of your portfolio that you happen to buy at the peak. Other things to note, just be wary of fear-driven pessimism in real estate or any other asset class. If you want to scare the crap out of you, or at least you know what I'm talking about, there's a lot of these types of fringe websites out there, Twitter, Zero Hedge, and trolling the comment section of the viral YouTube video, right? You guys know what I'm talking about. The current market filters retail from sophisticated investors. So sophisticated investors will look into the industry reports. A lot of the screenshots where I got from today, again, ITR Economics. These are a lot of paid sources that will consult for larger companies to help their economics department to dictate how they expand, hire, etc. This is the things that we'll take a look at when we look at economic trends. Number three here, use pessimism for strategic acquisitions and just make sure your long-term vision of what do you think is going to be around is reinforced. Look beyond the current present. Don't look at what's been doing well the last 1 to 3 years, because again, in theory, those are the things that are high and due for a correction. Look for where the value is, where the discounts are. This is a multi-focused strategy, right? You have to invest in alternative assets to get the passive losses there in real estate and maybe even get into private equity. But don't forget about the infinite banking section. I think that's module 10 in this masterclass. The key there is to configure it the right way. Just because it's infinite banking doesn't mean it's configured the right way in terms of pricing. If you guys need a referral, just reach out, shoot us an email, and they can get you a quote on that to get that going. And then especially you guys making over $350,000 a year, a lot of the more low-hanging fruit in terms of money saved, money earned is going to be through taxes. So a lot of different strategies there. Looking back, when I got involved in this world, I had 11 rental properties in 2015, but I was doing things wrong. It wasn't until I had other accredited investors around me that I realized of this kind of triangle that I teach today: alternative investments, taxes, and infinite banking, and how it all plays together. This is why we urge people to join the Family Office Ohana Mastermind, which is our virtual Ohana. All of us are pretty busy out there, so this is the most conducive way to interact with other purely passive accredited investors. And depending on when you meet us, we've got the annual retreat at the beginning of the year. That's the one time we open up the doors to outsiders or new people to get to know myself and build a relationship. Because what you're seeing on the private equity side and the real estate side deals, a lot of these are just pre-existing relationships, which kind of enter us into a deal, whether they're from a broker, somebody's got a project under contract, or our pre-existing partnerships that we've had and operational partners. And then, of course, try and diversify your portfolio, whether that means you've been doing this for quite some time. Try and achieve that 4 to 7 year spread of your investments. But if you're newer, go in with that longer time horizon. And you're not trying to time the market. You've got to just get going and build this time horizon. And then a last quote here, and I'll say this, hopefully it sinks in: embrace the future, not is when fear is high, but when for a 5% treasury bill may seem like a comfort like it is today. So me play around these online savings accounts that get that. It is in the decades that come that you will reflect upon this moment and see what you started and what you created. Because as cap rates move from mid sixes back into the fives, that means that $26 million asset I would mention in the beginning now sells for the mid 30s or maybe gets into the 40s. At that point, it's not about an extra 5% every year. That's when you get these big dumps of return on equity and capital. And that's where you really see the aha moment. Oh, now I see why investors invest in this fashion. More on the doom and gloom. The last time we had Pauly D from Jersey Shore giving financial advice on, what was that? The Fox News. That's the stuff that you have. And then you have Roberto Kiyosaki here. He's always putting out these tweets. And it's not him. It's always like his social media people just trying to get a bunch of viral exposure there. But you've seen all this in this funny timeline of him just crapping on the economy. His deal is to sell books, and the way you sell that is with fear mongering. And typically what a lot of these guys will do is they'll try and scare the crap out of people and funnel them directly into their revenue sources and selling gold and getting commissions off of that and fear mongering people in that direction. So a lot of this has dictated on interest rates. And here, what we're looking at right now is the January 2024 interest rates about a year ago. And at that time, the interest rates hadn't gone down yet. So you're still seeing this thing sit at 5.5. And this was the projections that you saw ensue over the next year. Obviously, as a year later, clarity has unfolded. We now have confirmed the top of the interest rate cycle. And as we've come down maybe about 10, 20% at this point. but you're seeing a little bit more clarity on how interest rates will fall and level off at this point at 4%. So probably a little bit more of a decrease this year, but we're seeing that equilibrium point where inflation is at lows right now, maybe not quite to what they want, but I don't know if 2% is achievable. A lot of people think that maybe 2 to 3% is more of that acceptable range, maybe in 2 to 4%. And we're certainly there at this point. And you're starting to see that leveling off or finding that equilibrium, that perfect homeostasis point of interest rates and inflation. Of course, things will always change. Something will happen. A black swan event may happen. Black swan events are something that happens in a blue moon. You can never predict it. It's always looming. A good example would be the Ukraine war or near miss when Kim Jong-un in the early 2000s was threatening to bomb the United States with a nuke. And then Dennis Rodman disaster, this, that, and we all forgot about that, right? Those are examples of black swan events. One black swan event that was triggered was certainly 40-year high in interest rates, the quickest in history, certainly qualifies for a black swan event. Certainly a pandemic was a black swan event. And this is where we live in a world of uncertainty. Things will always happen. And this, again, why I say you just can't time the market. And to wrap things up, with uncertainty, what do? Right? We know what's going to happen if you keep investing in the traditional investment world. That was where I started personally. And I realized that getting a little bit more involved, investing off the beaten path was going to get me a lot more returns. Sure, maybe it came with a little bit more risk, but it was a sort of acceptable risk-adjusted return, at least for myself. Now, everybody needs to come up with their own decision. I would just say, try and get around other people actually in this world and quietly doing this types of stuff. Try and figure out what your investment thesis is. One of my investment thesis is workforce housing because of this long-term trend for population in America increasing, especially on the lower middle class side. And we constantly have immigration. People are always falling from the middle class to lower middle class and living in smaller quarters such as apartments where we're got that exposure in, the good exposure in. Obviously, you're seeing this trends of rents increasing in comparison. Like I mentioned, the taxes and insurance going up in comparison to people's mortgages. And this is just all a long-term trend to be becoming more of a nation of renters. Now, the last time that there was a reversal of this was when George W. put into practice and had this idea like, oh, everybody should own a house. We all know that's not correct, but that was a political agenda put through at that time. And we all know how that played out, right? They created a lot of these no income, no job ninja loans out there. And what propelled the great financial crisis with a lot of these stupid loans going out to a bunch of deadbeats, as depicted in the movie The Big Short. Since then, they've tightened up lending standards to hopefully never have that happen again. As I mentioned earlier, there'll always be a different type of black swan event. That was obviously a black swan event, a culmination of multiple things. At this point, this is the long-term trend that we become a nation of renters. And I would say that this probably follows a trend of the majority of different nations out there. Unlike Japan, China, a lot of these countries where you're having a lot less younger people being born, so population shrinkage. America is on the other side of that, where you still have a nice type of proportion between the different generations, culminated with, again, the lower middle class is expanding. So this is the last slide here. Right now, within our organization, we've got a few different types of deals. We got started with the multifamily value add space, which I would probably put maybe around here. And then the development, which is a little bit more on this spectrum. And then now we're getting more involved in PE, buying businesses, M&A, which is more on here. Still within the middle of this spectrum. As you go to the right, your risk and reward could go up. Further along the spectrum is venture capital and angel investing. We're investing in an idea or a company that's not making any revenue yet. It's a pipe dream, but it could just blow up and do amazing. More than likely, some people call it like 90% of the time, you're just going to lose your money. What we like about business investing, PE investing, is we're investing in assets that have existing cash flow. It's already profitable. like an apartment that's 80, 90% occupied, right? Like we have existing financials, existing track record that we can benchmark and do our underwriting against and projections on. Now, on the other side of the spectrum, you've got the life insurance. That's what the accredited investor banking, infinite banking is all about. I think it's a great option for certain people as part of their portfolio with that. I certainly have my fair share of that. It's a great way to balance your portfolio. And this is where I'm not a certified financial planner. So technically, I'm not supposed to give any advice in terms of asset allocation, but this is how you're allocating your assets based on this risk reward spectrum. If you just invest at 5% in life insurance, which is probably your more secure types of investments, that and T-bills, you're very secure, but that's not going to get you anywhere, right? You're barely keeping up with the pace of inflation. Now, the trick is balancing your low risk investments with your high risk investments. So the barbell portfolio that I just personally do is I have a lot of things that are like life insurance that are very secure. And I have things that are on the more center to riskier side of this spectrum. So I don't have any of that stuff in the middle. And that's, if you think of a barbell, you're working out that middle bar, that's the stuff I don't have. It's non-existent. So I don't have any stocks or 401k stuff. To me, the reason I don't do that is because they're institutional products. It's like REITs. REITs are institutional products, a lot of bloat, a lot of fees, barely make anything in that type of stuff. Where when you're investing in alternative assets, ideally you're investing more directly with the sponsor operator and you're cutting out all the middlemen, which is why the returns are higher. But it requires you to get more connected, more involved, do a little bit more understanding on what you're investing in, maybe even more importantly, who you're investing in. What we're also going to be unrolling out is debt investing here in the near term future, probably getting into middle 2025. It's a form of putting out short-term loans on commercial and residential assets. It usually gets you about low double-digit returns there, but it comes with cash flow. And the nice thing there, it's always backed by an asset and has a better placement on the capital stack. Now, where sophisticated investors like debt investing, and sophisticated meaning higher net worth guys, and when higher net worth guys, as your net worth increases, you tend to get a little bit more safer. Where sort of my whole theory, and just speaking from experience, in my 20s and 30s, I was very risky, right? Like that's what kind of got me to where I am at today. And also what started the momentum in terms of building the relationships that we have today. That's each to their own, right? That's where you have to figure out what your comfort level with this stuff is. But I think that's where it's smart to get around other people doing this stuff as opposed to the other cubicle dweller who's never done anything other than a target date index fund. Of course, beyond this is the taxes and infinite banking that also combos in with this whole strategy. So here's basically what we have today. We have kind of three lobster traps. We've got the multifamily value add, the traditional stuff that we did when we started and we'll continue to do. So I think we'll do it with a little bit more selectiveness. The multifamily value add space where you're buying 1960, 2000 build, and you're renovating the units and eventually flipping it over the course of maybe 5 years. That, again, probably is put somewhere around this threshold here. The development, more value add, you have to defer there's no cash flow, and those types of investments are more in here. And then the business investing, the PE is just more on this side of the spectrum, still all in the center of the fairway here. The reason why I like the strategy for us, or at least speaking for myself, is now it allows me to be more selective and cherry pick out of these three different buckets, as opposed to just being a mobile home park investor and that's all I do, right? It's not a very diversified portfolio in that respect. And secondly, when you're investing with real estate, as we mentioned earlier in this slide, what you're seeing is the interest rates are not projected to go back to zero like it historically was these last 10 years. Like I doubted it for a long time to face reality. I come around quickly. Gone are those days. Now, maybe something will happen in the economy, maybe some type of war that happens and it brings back the good old days. But Right now, we have to operate on the best data that we have, and that's the Chatham Financial Curve or the CME. These are the rate cap providers that build these types of models. And we just have to assume that those lower interest rate periods are gone. The thing about real estate, and again, I'm not poo-pooing on real estate here. I think it's great, got great tax benefits. And if you can execute a business plan, you can make money in any environment. But you really need good leverage to make real estate move. And they give you good leverage traditionally. Now, not the greatest, but who knows if it's ever going to be coming back. That this has pushed us again to, all right, if one of our big tailwinds, which is great interest rates, great capital markets, great loans, is gone, we need to move. We need to be nimble, or we need to adjust with the times and not just be real estate. And that's where the business investing comes into place. And we were just very unfortunate with such a vast investor network of passive investors and also vendors that we've met along this journey, right? Some of the people that we're having talks with are like pool cleaning companies, property management companies that we've worked with in our own assets. We've seen and worked with them and know how they do business and how their owners ethically do business. And we've gotten to know a lot of good people by joining up with different groups, being part of different business owner circles. It gives us a lot of good insights, and being part of communities. Like I mentioned, the e-commerce, the SaaS and content website, online business world is an extremely small ecosystem. I would probably say a tenth of the size of the real estate syndicator universe, which makes it a lot easier for us to navigate, build relationships, and pinpoint who are the people that we want to work with, picking the right jockeys to then go and pick the right assets to partner alongside with in great acquisitions. And we saw a huge correction in commercial real estate. It obviously was not fun to go through, but things happen for a reason, right? I obviously prescribe to the Stoic approach, and that's through the obstacle is the way. And when things happen on the surface that isn't the greatest, there's always a double meaning in anything. And that was how we came to this newest generation of investing in businesses and moving in that direction. Again, we're not going to be abandoning what's worked in the past. We're just expanding the horizon here. So for those you real estate diehards, you can, I think, expect similar things, but also expanded deal flow from a new path, a path that I think is a lot less competitive, especially when you get into these really obscure types of acquisitions or asset classes or these business industries. The last thing I'll say on that is we are essentially micro private equity. We play in the space where the big guys, the big investment houses don't want to go to. And we also provide a great alternative for these business owners to sell to us or partners to work with us because we provide an alternative business plan. So normal traditional private equity is pretty vulturous. They want to go in, pump and dump, change stuff, disrupt that business, that family, that owner created, took so long to create. I'm not sure the owner wants to get some money because they did a good job. Sometimes they want to just keep the good times rolling, keep that ATM machine. And also that business was a big part of their meaning in life. And sometimes they have a real attachment to the employees. So that's where our focus is when we go into business investing. Isn't necessary to pump and dump these assets. It's a lot of it is just cash flow based. And when you're in this business investing world, the cash flow is way stronger than what you can get on a real estate asset. Also, from a tax standpoint, it makes a lot more sense to not sell the assets and turn and burn them like you can with real estate, where you have a lot of passive losses and those types of strategies there. But I think that what's super cool is you can combo some of these tax benefits when you do go into the business investing. And again, talk to your own CPA. We can provide some referrals. But if you're able to pool some of these passive losses from your real estate holding side and use it to offset some acquisitions, some passive income on the business investing side, the PE side, then I think it creates some nice synergies here. And it's things that I'm taking advantage of myself. My job these days is to interact with higher net worth people as we're trying to buy properties or assets from them. and just swim upstream, work with better people, get away from the non-accredited crowd of unsophisticated investors out there on the real estate investment forums, that type of people, and get more to family office quality type of operators and deals. And part of that is going in and finding these deals and operators, many of which are not the flashy people. These guys don't have podcasts, they don't have YouTube channels. They are very quiet and oftentimes introverted. Some would say even socially recluse a little bit, which is what we actually look for. We want to look for somebody who's a good operator, which typically, when you think in terms of left brain, right brain, is the opposite of somebody who's a good marketer. So that's give you guys a little insight into kind of what we look for in terms of when we find deals on the PE side and the real estate side too. But that is the action plan for this year. If you guys have any questions, check out future office hours that we'll do the first Saturday of every month. We're also unveiling the deal desk. A lot of you guys are around looking for deals out there. Get things in your inbox, gets a nice shiny PDF. We can run it. We've got access to the institutional due diligence, and we can do due diligence and different partners. And eventually we actually do go out there and look at the asset if we get serious about it. But we're actually, in a way, it's a win for both of us, right? We get access and see what else is out there, use you guys as satellites. But then I think who wouldn't want an over the shoulder review with a group that's done well over $2 billion of deals out there at this point? Obviously, a lot of lessons learned that we've had in our past. So with that, I'm going to close this session. Thank you all for listening, and we'll see you on the next one.